On a single Monday morning in October, the American stock market lost almost a quarter of its value in 6.5 hours. Not over a year, not over a month, in one day. 22.6% gone in an afternoon. It is the worst single day in the history of Wall Street, and almost nobody talks about it anymore. My name is Marcos, and I have spent years studying the exact moments when markets break. Because those moments tell you more about money than any bull market ever will. Most finance channels only show you the green charts and the easy wins, but the real edge comes from understanding the days everyone wants to forget. If you want to invest like someone who has already lived through the worst, you are in the right place. This one matters. Here is something that should genuinely scare you. The average investor today has never actually seen a real crash. If you started investing in the last 15 years, you have only ever known a market that goes up, recovers fast, and forgives every mistake. Every dip got bought, every panic got rescued. And somewhere along the way, you started to believe that this is just how markets always work. But that belief is a trap. It is the most comfortable trap ever built because it feels exactly like wisdom. Because the market does not actually owe you a recovery, it does not care about your plans, your retirement date, or how much you think you deserve. On October 19th, 1987, an entire generation of investors learned that lesson in a single afternoon. They watched their wealth evaporate faster than anyone thought was mathematically possible. Brokers stopped answering their phones, and the screens froze. People who felt rich on Friday felt poor by Monday night. And here is the part that most people completely miss, and it might be the most important point in this entire video. Black Monday did not happen because the economy collapsed. There was no war, no banking failure, no recession in sight. The fundamentals were fine. The crash came from something far more dangerous, the way modern markets are wired to feed on their own fear. That same wiring still exists today, bigger, faster, and more automated than it was in 1987. So the question is not whether it could happen again. The question is whether you will understand it when it does. Now let's go back to that Monday. To understand how big Black Monday really was, you have to understand the number. The Dow Jones fell 508 points in one single session. In 1987, that was 22.6% of the entire market, wiped out between the opening bell and the close. Let me put that in perspective. The famous crash of 1929, the one that started the Great Depression, dropped the market about 13% on its worst day. Black Monday was nearly twice as severe. In a few short hours, roughly $500 billion in value simply disappeared. To make it personal, imagine you had $10,000 invested on Friday afternoon. By Monday's close, around $2,260 of it was gone. You did nothing wrong, you made no bad trade, you just woke up poorer. Now here is where it gets really interesting, and this is something that will probably surprise you. The strange part was how quiet the warning signs had been. Earlier that year, the market had been absolutely on fire. By late August of 1987, stocks were up more than 40% for the year. People felt unstoppable. The mood was pure euphoria. Everyone was a genius, and every chart only pointed one way. And then, over a few weeks in October, small cracks began to appear. Interest rates ticked up, a trade deficit report spooked investors, and a little fear crept in. By the Friday before Black Monday, the market had already slipped, and nervous money was looking for the exit. Then the weekend hit, and millions of people sat at home with the same anxious thought. What if I sell first? What if everyone else sells, and I am the last one left holding? On Monday morning, they all tried to do exactly that at the same time. The selling did not arrive like a wave, it arrived like an avalanche, and the machines made it so much worse. They did exactly what they were told, and that was the whole problem. Here is something that might genuinely blow your mind. A huge portion of that crash was not caused by humans panicking. It was caused by computers following instructions written by humans who thought they were being safe. That single design choice turned a bad day into the worst day in market history. And to understand why, you have to understand the psychology that was quietly running underneath the entire system. Let me give you a number that will put this in perspective. In the years before 1987, Wall Street fell in love with an idea called portfolio insurance. The promise was simple and seductive. It claimed it could protect big investors from losses automatically. The way it worked sounds reasonable at first. If the market started dropping, computer programs would automatically sell stock futures to hedge the losses. In theory, you could never get badly hurt because the machine would always sell on your behalf. But here's where most people mess this up, and I see it constantly. A strategy that protects one person can become a catastrophe when everyone uses it at once. Think about it. Really picture the chain reaction. If your computer is programmed to sell and my computer is programmed to sell, what happens? We all sell at the very same moment. That selling pushes prices down further, which triggers even more automatic selling, which pushes prices down again. It is a feedback loop with no brakes. This is the financial version of everyone running for the same exit in a crowded theater. The door that was supposed to keep you safe becomes the thing that crushes you. And underneath the machines, there was an older, deeper force at work. Fear, pure, primal, contagious fear. Human beings are not wired to stay calm while they watch their savings disappear in real time. Our brains treat financial loss almost the same way they treat physical danger. The same stress chemicals flood the body, and the same instinct screams at us to run. So when investors saw red numbers cascading down their screens, logic shut off and survival mode took over. Nobody was thinking about company earnings or long-term value. They were thinking one single thing: get out now. Now you might be thinking that you would have stayed calm, that you would have held your ground while everyone else panicked. And while there is some truth to that, the real lesson is much harder. The system itself was designed in a way that punished calm and rewarded panic. The people who sold fastest lost the least in that single violent moment. And that is exactly the trap that makes crashes so brutally violent. The tools built to remove fear ended up multiplying it. Safety, it turned out, was the most dangerous illusion of all. Which brings us to the part that almost nobody expects. Here's the part that nobody in finance likes to talk about. Black Monday, the single worst day in stock market history, barely mattered in the long run. Let that sink in for a second. The day that ruined a generation also quietly rewarded a patient few. The most terrifying day Wall Street has ever seen turned out to be one of the greatest buying opportunities of the decade. Here is the proof. After losing 22% in one day, you would expect 1987 to go down as a disastrous year. But it did not. By the time the year actually ended, the market was still up for the year. Read that again. The year of the worst crash in history closed in positive territory. The crash was real, the fear was real, but the long-term damage was almost an illusion, and it gets even more remarkable. The economy outside the stock market barely flinched. There was no depression, no mass unemployment, no collapse of the banking system. Companies kept selling products and people kept going to work. The thing that felt like the end of the world was, in reality, a violent mood swing in the price of paper. Now here is where things get really interesting. Imagine two investors on that very Monday night. The first one panicked, sold everything at the bottom, and swore he would never touch the market again. The second one did something that felt insane at the time. She decided to buy. She saw great companies suddenly selling for 20% less than a week earlier. Fast forward just 2 years, and the market had completely recovered everything it lost. Fast forward a decade, and the second investor had multiplied her money many times over. The first investor was still sitting in cash, still afraid, still telling himself he was smart. The difference between them was not intelligence, and it was not luck. It was their relationship with fear. One ran from it, the other simply refused to. And this is the part the headlines never capture. Crashes do not destroy wealth evenly, they transfer it. Not $1 truly vanishes, it simply changes owners. They move money from people who panic to people who stay calm. Every single market crash in history has followed this same quiet pattern. The crowd loses and a small group of patient people wins. And the gap between those two groups is almost never about money, it is about temperament. And this is where the math starts getting really exciting. Let me show you what staying calm has actually been worth over time. There is a famous study about what happens when you panic and miss the market's best days. Because here is a strange truth about crashes. The biggest up days in market history tend to happen right next to the biggest down days. They cluster together during periods of maximum fear. So the investor who sells to escape the pain almost always sells right before the violent rebound. Consider this. The numbers here are almost hard to believe. If you had stayed fully invested over the past few decades, your money would have grown at a powerful long-term rate. But if you missed just the 10 best days, your final result would be cut roughly in half. Miss a few more of those days and most of your gains disappear entirely. And when do those best days happen? Right in the middle of the crashes, when selling feels like the only sane option. So the panic that feels like protection is often the single most expensive decision an investor can make. Now apply that directly to Black Monday. If you had invested $10,000 the day before the crash and simply done nothing, that money would have grown many times over by today. The crash that felt like a catastrophe would be a tiny, almost invisible dip on a long upward chart. This is the pattern that repeats across every single era. 1987, the dot-com crash, the financial crisis, each one felt like the end. Each one looked decades later like a discount. The numbers are remarkably consistent. Different decade, same lesson, every single time. The market has survived world wars, recessions, pandemics, and panics, and the long-term trend has always pointed in the same direction, up. Not in a straight line, never in a straight line, but up. And once you truly understand that, something changes inside you. You stop seeing a falling market as a threat. The red numbers stop looking like danger and start looking like price tags. You start seeing it for what it actually is, a temporary sale on the most powerful wealth-building machine ever created. And that brings us to the most important shift of all. Because this was never really a video about 1987. It is a video about who you decide to become before the next crash arrives. And make no mistake, another one is coming. Maybe not this year, maybe not next year, but it is coming. Because fear is a permanent feature of markets, not a temporary bug. The only question is what kind of investor you will be when it does. The one who freezes, the one who flees, or the one who finally steps forward. Most people make a quiet promise that they will be brave when the time comes, but courage is not something you summon in the middle of an avalanche. Courage is something you build in advance on calm days like today. You build it the same way you build muscle, slowly, deliberately, and long before you need it. You build it by deciding, right now, exactly what you will do when the screen turns red. You build it by understanding that a crash is not a sign to run, but a signal to stay. You build it by automating your investing so your future does not depend on your mood. The investor who survives a crash is not the one with the most money or the highest IQ. It is the one who decided long before the storm that they would not flinch. That single decision made in advance is worth more than any stock tip you will ever hear. Because the truth is simple, the market does not reward the smartest people, it rewards the calmest ones. It rewards the people who can sit through the noise and ignore the screaming headlines, and keep believing in the long game when everyone around them is convinced the world is ending. That is the real skill. It is boring, it is unglamorous, and it is absolutely everything. Not picking the perfect stock, not timing the perfect moment. Just staying in your seat when the entire crowd is running for the door. Just trusting the math when your heart is screaming at you to quit. Master that one thing, and you have mastered the part of investing that actually matters. So, let's go back to where we started. A single Monday morning, a market that lost almost a quarter of its value in a few short hours. To the people who lived through it in terror, Black Monday felt like the day the world of money died. But to the people who understood what was really happening, it was just a moment of fear in a much longer story of growth. That is the secret that nobody remembers. History did not hide it from us. We simply chose to look away. The crash everyone was supposed to fear became the opportunity almost nobody seized. And the next time the screens turn red and the headlines scream panic, you will not be running for the exit. You will be the calm one in the room, the person who already knows how this story ends. You will have seen this movie before and you will know it is not a tragedy. Because the wealth was never in avoiding the storm, it was in learning how to stand still inside it. The storm always passes, but the habits you build inside it stay with you forever. If this changed the way you see market crashes, watch this video to understand the real estate market. I will see you there.